Welcome back. We're still on chapter 3. I think we'll spend a little bit of time working on problem PA3-2. It's one of your assignments for chapter 3. And again, keep in mind we're working in the textbook problem, and you're going to be working on the Connect site. Same problem, different numbers. Okay. So in problem PA3-2, recording journal entries. Let me quickly read through the instructions. It says, Diana Mark is the president of Service Pro Inc., a company that provides temporary employees for not-for-profit companies. Service Pro has been operating for 5 years. Its revenues are increasing with each passing year. You have been hired to help Diana in analyzing the following transactions for the first 2 weeks of April 2010. And so we have a number of April dated transactions, and I'm not sure if we'll have time for all of these, but we'll go through a few of them. And what's required is for each of the transactions, prepare a journal entry. And so you might want to quickly review the journal entry format, and those are shown on a number of pages in the chapter, starting on page 105 and moving forward. A number of transactions, and for each transaction in green you will see a journal entry prepared for the transaction. So that would be the format that we want to use. Okay, April 2nd, purchased office supplies for $500 on account. First step again is to analyze the transaction. What kind of transaction is it? Well, we purchased office supplies and we bought those supplies on account. So we need to think about which accounts are affected. Keep in mind, every transaction affects at least 2 accounts, could be more, but generally 2 accounts. We made a purchase. We bought office supplies. Office supplies is one of those accounts that are affected. Office supplies is an asset account, and so that asset account is going to go up, and the amount of the transaction is $500. So just in broad categories, we add 500 to assets, and that asset is office supplies. Now, we bought those supplies on account. That means we're going to receive the supplies now, pay later. When we buy on account, payment to be made later, that means we owe an amount to be paid at a later date. An amount we owe is a liability, and so we will add to a liability account, and that liability account we would generally use accounts payable for in this type of transaction. And so our transaction would be journalized with a debit to office supplies 500, and a credit to accounts payable 500. Debits equal credits. Each and every transaction, the debit amount and the credit amount are equal. Okay, next transaction on April 5th. Billed the local United Way office $1,950 for temporary services provided. Temporary services provided. Again, what kind of company are we? We are a company that provides temporary employees for not-for-profit companies. That's what we do to earn revenues. So what type of transaction did we have there on April 5th? We billed the local United Way $1,950 for temporary services provided. We provided services, we have earned revenues. So we are going to record a revenue. So we're going to add under revenues 1,950. And the question is, did we receive cash or will we be paid later? And it looks like we billed the United Way, so they're going to pay us at a later date, probably next month or at some later date. And so we don't have cash. We're not receiving cash in that transaction. Rather, we are receiving their promise to pay us later. We call that account that we use for that type of transaction accounts receivable. That's basically a credit sale. We made a credit sale. And so we're going to add to the asset account accounts receivable. And so our transaction would be journalized with a debit to accounts receivable, 1,950, and a credit to our sales revenue account, and not sure what we're going to call our sales revenue account. Well, let's call it temporary services provided, or let's just call it services provided. So our revenue account will be a credit, and we will call that account services provided, and that amount will be recorded as a credit, $1,950. Okay, transaction 3 on April 8th, paid $250 for supplies purchased and recorded on account last period. So in this transaction, we already recorded this purchase of supplies last period. So we already did the purchase in March. The April transaction on April 8th is for payment of a past purchase on account, or a past purchase on credit. And the payment amount is $250, and we're paying cash. So cash is an asset, so we will subtract $250 from the asset cash. Now, what account shows an amount that we owe? This was a purchase that we recorded last month. So last month we would have added that amount to accounts payable to be paid this month. The account that shows the amount we owe is accounts payable. And because we're making payment on it, we need to show that that account is decreasing. So we are going to subtract that amount, $250, from the liability account, accounts payable. And so how we record it would be with a debit to accounts payable to show that we are making payment on account, debit accounts payable $250. And anytime we make a payment on an amount we owe, that's going to result in a credit to cash. Cash is going to decrease for the amount of our payment. And so our credit will be to cash in the amount of $250. Now, I'm going to stop at this point. I think this gives you basically it gives you an idea of what you need to do to complete the problem. Remember, for each transaction, you need to analyze the transaction, figure out what kind of transaction it is. You need to classify the transaction, figure out which two accounts are affected by that transaction. For each of the two accounts affected, did each account go up or go down? Did it increase or did it decrease? And then based on whether the accounts went up or down, and based on the rules of debit credit, you would either debit or credit each of those two accounts. Keep it in mind, every transaction affects two accounts, could be more, but at least two accounts. And for each transaction, the total amount recorded as a debit and the total amount recorded as a credit must always equal. I think that's good for now, and we'll come back to another lesson shortly. Thank you.